Something happened this week that I want you to sit with for a moment before I explain it. In 48 hours, over $6 trillion of market value disappeared. Not gradually, not over weeks, 48 hours. The S&P 500 lost 10%. The Nasdaq entered bear market territory. The VIX, the number that measures how much fear is priced into the market, spiked to 45. The last time it was that high was March 2020, when the world didn't know how bad CO was going to get. Oil collapsed, copper collapsed, and gold, the asset that every financial advisor, every macro commentator, every central bank on the planet has been telling you is the ultimate safe haven during exactly this kind of chaos. Gold also fell. Everything went down simultaneously during a trade war that every economist on the planet says should be inflationary. Now here is the question I want you to hold in your mind for the next 20 minutes. If tariffs cause inflation, and inflation is historically good for hard assets like gold and commodities, why did everything collapse at the same time? Why did the assets that are supposed to protect you from this environment fail to protect you from this environment? The answer to that question is not what you have been hearing on financial television, and understanding it will change how you read every market event for the rest of the year, possibly for the rest of the decade. I have spent my career studying economic systems, not individual stocks, not quarterly earnings. The systems, the patterns that repeat across decades because human nature does not change. Debt cycles do not change, and the mechanical relationship between policy decisions and asset prices does not change. What I am watching right now is not new. The specific trigger is new. The transmission chain is 50 years old. And if you understand the transmission chain, you stop reacting to the daily noise and start positioning for the outcome that the structural forces are pointing toward. Let me start at the beginning. On April 2nd of this year, the United States announced what was described as a universal tariff on all imports, a 10% baseline duty applied to every country simultaneously, with higher reciprocal rates on approximately 90 nations. The stated intention was straightforward: protect American manufacturing, repatriate jobs, generate federal revenue, and correct what the administration described as decades of unfair trade. The immediate market reaction was a sell-off. The following day, China announced a 34% retaliatory tariff on American goods. The sell-off accelerated within 2 sessions. The numbers I described at the beginning of this video were reality. Now, the conventional explanation goes like this: markets don't like uncertainty. Tariffs create uncertainty. Therefore, markets sold off. That explanation is not wrong, but it is approximately as useful as telling someone whose house is flooding that water is wet. It describes the surface. It does not explain the mechanism. And without the mechanism, you cannot know how deep this goes, how long it lasts, or what to do about it. So let me give you the mechanism. A tariff is a tax. This is not a political statement. It is a definitional one. When a government imposes a tariff on an imported good, the cost of that tariff has to be paid by someone. The question of who pays it is the most important economic question in this entire situation. And the answer is not the one you hear most often. The common assumption is that foreign exporters absorb the tariff, that the Chinese manufacturer or the German automaker simply accepts a lower price to maintain market access. The data from every major tariff episode in recent history, including the 2018 and 2019 China tariffs under Trump's first administration, shows this is not what happens. Independent analysis from the Congressional Budget Office and multiple Federal Reserve regional banks consistently finds that foreign exporters absorb somewhere between 4 and 10% of the tariff cost. The remaining 90 to 96% is passed through to American importers, the U.S. companies buying those goods, and from there to American consumers through higher prices. This means the tariff functions as a broad-based consumption tax on the American economy. Every dollar collected in tariff revenue is a dollar extracted from the disposable income of American households and the operating margins of American businesses. Consumer spending capacity falls. Corporate earnings expectations fall. And since the stock market is ultimately a claim on future corporate earnings, a present value calculation of cash flows that companies will generate for their shareholders. When earnings expectations fall, stock prices follow. This is not fear. This is arithmetic. But here is where it gets considerably more complex and considerably more dangerous. Tariffs are also inflationary. When import costs rise across the entire economy simultaneously, the broad price level rises. This is not a theory. Jerome Powell said it explicitly at the most recent Federal Open Market Committee meeting, noting that elevated consumer prices largely reflect, in his words, inflation in the goods sector, which has been boosted by the effects of tariffs. He said this twice at 2 consecutive meetings. The Federal Reserve's own inflation forecast for 2026 was revised upward. GDP growth was revised downward. The central bank is watching an economy where prices are rising and growth is slowing at the same time. This condition has a name. It is called stagflation. And stagflation is the one macroeconomic environment where the Federal Reserve's primary tools, interest rate adjustments, become genuinely impotent. Think about the bind this creates. If the Fed cuts rates to stimulate a slowing economy, it risks making inflation worse because cheaper credit in an inflationary environment adds fuel to the price spiral. If it raises rates to control inflation, it risks accelerating the economic slowdown because higher borrowing costs suppress investment, housing, and consumption at precisely the moment when those things are already under pressure from tariffs. The Fed cannot move in either direction without making one half of the problem significantly worse. So it does what it has been doing. It holds. It waits. It says uncertainty is remarkably high, which it is, and it does nothing. Now here is the part that most people are missing entirely. For 15 years, from 2008 through approximately 2022, markets operated under a specific and very powerful assumption. The assumption was this: whenever a significant market decline occurred, the Federal Reserve would intervene. It would cut rates. It would expand its balance sheet. It would inject liquidity. This intervention happened so reliably and so predictably that traders developed a name for it. They called it the Fed put. The idea that the central bank was effectively providing insurance against catastrophic market losses. Buy the dip because the Fed will always step in. That assumption is now genuinely in question, not because the Fed doesn't want to help, but because the inflationary constraint created by tariffs has removed the policy space that the Fed would need to intervene in the traditional way. When inflation is already above target and tariffs are actively pushing it higher, cutting rates is not a viable response to a market decline. The insurance policy that the entire market has been priced around for 15 years has become conditional. And when the market realizes that the insurance it was counting on may not pay out, the repricing is not gradual. It is abrupt. It is the kind of repricing we saw this week. But there is still another layer. And this is the layer that explains why gold fell alongside everything else, which I know is the specific question many of you came here to understand. Over the past 2 years, as gold climbed from approximately $2,000 per ounce to its January 2026 high of $5,595, retail investors poured money into the gold market in a specific and important way. According to available data, approximately $70 billion flowed into gold exchange-traded products between 2025 and early 2026. A significant portion of that capital went not into straightforward gold exposure, but into leveraged gold products, instruments that offer 2 or 3 times the daily return of the gold price. These products require daily rebalancing. When the price of gold falls, the leveraged product must sell gold futures to maintain its leverage ratio. That selling causes the price to fall further. The further decline triggers margin calls on other leveraged positions across the portfolio. And those margin calls force the liquidation of whatever assets can be sold quickly, which includes not just gold, but equities, oil futures, copper, and every other liquid asset the fund holds. This is forced selling. And the defining characteristic of forced selling is that it is completely indifferent to fundamental value. When a fund receives a margin call, it does not ask whether gold is undervalued. It does not consider whether oil will recover. It sells what it has at whatever price the market offers, because it has no choice. This mechanical cascade, leverage accumulation on the way up, forced liquidation on the way down, is why everything fell simultaneously. It was not a collective judgment that gold was overvalued or that oil had no future. It was a liquidity event, a fire sale driven by the mathematics of leverage, not by any assessment of intrinsic worth. And here is the historical parallel that I find most instructive for understanding where this leads. In 1929, the United States economy was operating at historically elevated valuations, with a labor market that appeared strong and a policy environment that felt stable. The Smoot-Hawley Tariff Act, which raised import duties to their highest levels in American history, was passed in 1930, not at the beginning of the crash, but during it. The tariff was intended to protect domestic industry and reduce unemployment. Trading partners retaliated immediately. Global trade volumes fell by approximately 65% between 1929 and 1934. Corporate earnings collapsed. Unemployment rose to 25%. What began as a financial crisis became a generational economic depression, amplified enormously by the trade policy that was supposed to contain it. I am not predicting a repeat of the 1930s. The policy tools available today are far more sophisticated, and the global financial architecture has circuit breakers that did not exist then. But the mechanism is identical. Tariffs raise costs. Trading partners retaliate. Global demand contracts. Corporate earnings fall. The Federal Reserve's room to maneuver narrows, and the economy enters a period of stagnation that is considerably harder to escape than a standard recession, because the inflationary component prevents the aggressive monetary accommodation that typically ends recessions quickly. There is also a more immediate parallel that I think deserves your attention. Last year, when the first round of sweeping tariffs was announced on what the administration called Liberation Day, the S&P 500 lost approximately 10% in 2 sessions, almost identical to what we observed this week. At that point, the administration paused some tariffs, offered exemptions, and the market partially recovered. Some traders interpreted this as confirmation of the pattern that has been called taco on Wall Street. The idea that the administration always backs down before the economic pain becomes too severe. That pattern may be correct or it may not be. And the problem with building an investment strategy around a behavioral prediction about a single decision maker's pain threshold is that you are not analyzing economics. You are predicting psychology. And psychology is considerably less reliable than mechanism. I would encourage you to focus on what the structural forces are doing, not on what you think a particular individual will or won't do under pressure. The structural forces are tariffs or inflationary. The Fed is constrained. Corporate earnings are under compression. Leverage is unwinding, and global trade is contracting at the margin. Those forces do not change based on tweets or press conferences. Now let me turn to what the second and third order effects of this environment look like over the next 12 to 18 months, because I think this is where most commentary is genuinely failing investors. The first second order effect is supply chain repricing. Global supply chains were built over decades around a specific set of tariff assumptions. During that transition period, input costs remain elevated for companies that cannot quickly source alternatives. Production efficiency falls as supply chains are reorganized under new constraints. And the inflation that tariffs create does not dissipate quickly, because the supply chain disruption compounds the direct price effect of the tariff itself. This is why economists at Morningstar and elsewhere are forecasting that the inflationary impact of the current tariff regime will last considerably longer than the initial shock. The Fed's constraint is therefore not a temporary condition. It could persist for 2 to 3 years. The second order effect is what happens to the dollar. This requires careful thinking because the dollar's near-term and longer-term trajectories are pointing in opposite directions, and conflating them is a significant analytical error. In the near term, during acute periods of market stress, global capital tends to flow into U.S. dollar assets, specifically U.S. Treasury bonds, as the world's most liquid safe haven. This supports the dollar in the short term, even as U.S. markets are falling. We saw this dynamic clearly during the initial phase of this week's sell-off. But over the medium term, there is a more complicated and potentially more consequential dynamic at work. When the United States imposes sweeping tariffs unilaterally, disrupts established trade relationships without warning, and uses market instability explicitly as a negotiating tool, as the administration has done openly, it signals to the world that American economic policy is less predictable than it was. Predictability is the foundation of reserve currency status. It is not enshrined in law. It is not guaranteed by military power. It is earned continuously through the reliability of the rules-based environment that makes U.S. assets worth holding. When that reliability is questioned at the margin, the dollar's reserve premium erodes at the margin. Not immediately, not completely, but gradually, and in ways that compound over years. The third second-order effect is the one that is most directly relevant to anyone watching this video who has savings, a retirement account, or a concern about their purchasing power over the next decade. When governments pursue policies that simultaneously suppress growth and sustain inflation, when they create the conditions for stagflation, the historical response has consistently and reliably been the same. Eventually, the monetary authority prints money. Not because it wants to, but because the political economy of prolonged stagnation with high unemployment and rising prices is unsustainable. The public pressure to do something becomes irresistible, and the something that central banks know how to do is inject liquidity and reduce borrowing costs. The timing and scale of that eventual response is uncertain. What is not uncertain is the directional consequence of it. More money in the system, lower real returns on financial assets, and a higher nominal price for everything that cannot be printed, including gold, including real assets, including hard commodities. This is the critical distinction between what is happening to gold right now, which is a mechanical liquidity event driven by forced selling, and what the structural forces are pointing toward for gold over the medium term. The forced selling is temporary by definition. It ends when the leverage clears. The structural case for gold, fiscal excess, monetary accommodation, dollar erosion, central bank diversification, is not temporary. It is the product of decades of debt accumulation and policy choices that cannot be reversed quickly or painlessly. The paper market is communicating fear and forced liquidation. The physical market, where central banks, Asian sovereign buyers, and long horizon institutions are accumulating at lower prices, is communicating something quite different. Let me be specific about what I think this means for how you should be thinking right now. The first thing I would encourage you to understand is the difference between an asset that is falling because its fundamental value has changed and an asset that is falling because leveraged participants are being forced out of their positions. These are not the same thing. A house that is worth $500,000 is still worth $500,000 during a week when the seller needs cash urgently and accepts $400,000. The price changed, the value did not. What you want to be watching is whether the fundamental conditions that determine long-term value have changed. And for gold, for hard assets broadly, for the real economy's ability to sustain purchasing power, those conditions have not improved this week. They have, if anything, deteriorated from a structural standpoint. The second thing I would encourage you to watch is the Federal Reserve's next move. Not the next meeting, not the next statement, the next fundamental shift in direction. When the Fed is eventually forced to pivot, when unemployment rises enough or growth contracts enough that the political pressure to ease outweighs the inflationary constraint, the reversal of all three headwinds that are currently suppressing gold will happen simultaneously. The dollar will weaken, real yields will fall. The liquidity that forced sellers removed from the market will return. Historically, these reversals have been fast and significant. The investors who are positioned before that pivot happens capture the bulk of the move. The investors who wait for confirmation that the pivot has occurred typically enter after most of the recovery has already taken place. The third thing I would offer is perhaps the most important, and it is the one that is hardest to act on because it requires resisting very strong psychological pressure. The worst investment decisions are made at moments of maximum apparent clarity, when the narrative is so dominant, so widely held, so constantly reinforced by every news source and every conversation, that departing from it feels irresponsible. Right now, the dominant narrative is that markets are collapsing, trade wars are uncontrollable, recession is inevitable, and the safest thing to do is reduce risk and wait for certainty. That narrative has enough truth in it to feel credible, but it is incomplete in a specific and important way. It describes the current phase of the cycle as if it were the terminal phase. It is not. The debt cycle does not end with a trade war sell-off. The structural forces driving monetary expansion, dollar erosion, and the long-term case for hard assets are not resolved by 2 bad weeks in April. They are accelerated by them. The system is under stress. Stress, understood correctly, is not chaos. It is the mechanism by which overvalued assets find their real price, over-leveraged positions are cleared, and the structural bid for genuinely scarce assets eventually reasserts itself. Understanding that mechanism, really understanding it, not just hearing the words, is the difference between being reactive and being prepared, between watching a $6 trillion loss and understanding what it actually means for the next 3 years. I have watched multiple cycles play out over my career. The pattern that I am describing is not new. The transmission chain from policy disruption to market stress to eventual monetary accommodation to hard asset outperformance has repeated itself with remarkable consistency across very different historical circumstances. What changes is the specific trigger and the specific timeline. What does not change is the underlying logic of how debt cycles resolve, how fiat currencies behave under fiscal stress, and how markets reprice when the assumptions they were built on are suddenly called into question. Pay attention to the mechanism. The headlines will change tomorrow. The mechanism will.